Hello. Yeah, sorry for that the connectivity issue of the host. So the spaces got disconnected because of that. Once we have all the speakers back, we'll restart again. Very sorry for that. We're just waiting for the speaker to join. Uh, Sorry for the connectivity issue. We'll just tap the speaker and back again and restart.
Yeah. Vignesh, can you make
I've already made Sham Shekhar also to
respond?
be a speaker. Yeah, he's yet to respond. Yeah,
To join.
yeah. Mr. Ashish has become a speaker now.
Can you hear me?
Yes, Mr.
Yes, sir. Yes, sir. Sorry about the connectivity issue, sir. You can carry on. Probably you can just start just a bit again.
Yeah, you can
Just briefly.
start, Ashish sir. You can start from the beginning because it just got tempo was lost.
Okay. So basically, what I was saying is the reason to look at sectoral investment themes as opposed to only look at compounders is a lot of times the market prices the compounders to the moon, and a lot of times you may be getting substandard returns if you keep holding on to your compounders at very expensive valuations. A lot of them may not be able to grow, and they become priced to perfection, and disappointments can lead to even losses on the portfolio. Case in point could be the FMCG stocks or some of those stocks wherein the PE multiples went above 100, 150, even 200 in certain cases. And for example, the retailer in terms of the brick and mortar retailer, which has been growing very well. So sometimes one needs to always look at what opportunities are the markets offering. The choice of the investment style also depends on how the markets are giving you opportunities. If it is giving you opportunities like 2013-14, when a lot of these compounders like the Mayur Uniquoters and a lot of auto ancillary stocks and other things, or sanitary players like Sarah and Sanitary Ware and all of them are appearing very cheap. So there are certain times you look at compounders as well, but there are certain times when markets are not giving you opportunities in the known compounders, and they seem to be quite expensive. So in such cases, especially to look at sectoral investing themes, wherein certain tailwinds are happening, and because of which the sector could become interesting, or because of ignorance of the market, the valuations have become again interesting because nobody's ready to look at these valuations. So during the time of 2007 bull market, the real estate infra was doing very well. At the same time, FMCG and other stocks were doing very available very cheap. So similarly, in the NBFC 2016-18 period, NBFCs were doing very well. Today, capital goods, defense, these kind of sectors are doing very well. Now, a few years back, they were not doing well. And right now, there are certain sectors which the market is completely ignoring, where the fundamentals are improving and things are getting better. So that is the job of an investor. Somebody as a retail investor who doesn't have the bandwidth, the time and the interest would be better off doing investing via mutual funds. But somebody who has time, has the inclination and interest and patience and can devote a few hours a week should be aware of opportunities coming across various sectors. Now, how we do is, I'll give you a few examples of a few sectors of how we are looking at them, just for illustration purposes, not as a recommendation. As I'd given the SEBI disclaimer earlier also, that is education advice. For example, the banking financial sector. Over the last 5-7 years, you know how the economy is deleveraged. A lot of corporates have paid back loans. How the formalization of the economy has led to increasing deposits in the banking and the financial sector. How, unlike the West, the domestic banking financial sector has been quite resilient. And as the economy is now growing, the banks are able to participate in the credit growth. Now, some of these banks, the mid-cap ones especially, look quite interesting in terms of valuations. Once you identify a sector in terms of where even the leader, like an HDFC Bank, is not more than 10% market share, and there's a massive value migration happening from public to private. So when you see those factors, when you apply our ranking of business models framework or any framework in terms of value investing or long-term investing, and you see that a lot of the stocks are looking at interesting valuations, then you go bottoms up also, be it the mid-cap segment or the large-cap segment, and you try finding ideas. So in the mid-cap segment, a lot of banks look interesting, like the federal banks, the DCB banks. Again, as studying at valuations look interesting. Now, fundamentally also, one finds comfort in the asset quality, in the management strategy, in the growth prospects. One can look at this sector. Similarly, there's a tailwind coming in the CUT education sector, wherein the CUT exams, which are replacing the exam, the 12th board marks in terms of admission process, is opening up a lot of opportunities for the edtech players. We even met some of them recently, the management's trying to understand. So when such opportunities comes, sometimes you're able to play them, sometimes not able to play them. And doesn't mean just because the opportunity is there that the players will be multi-baggers. You need to look at the track record, you need to look at the execution, you need to look at how feasible are the growth plans. So having understood that maybe the sector looks interesting, look at the players which are there in this industry, look at the track record, look at the governance thing out there. And if you find that the industry is consolidated and there's a chance that as the industry multiplies, for in the case of this edtech industry, the number of people sitting for competitive exams, for example, in MBA law, a few lakhs could go up to say 30, 40, 50 lakhs even. And that presents an exponential opportunity. Now, if you think the existing players could garner a good market share, it could present an interesting opportunity. And if the existing players are available at an interesting valuation, adjusted for cash, adjusted for the normalized earnings, that could become interesting. That's another way. Another way to look at this is, for example, post IPO of these tech stocks, a lot of them got pummeled down to 70, 80%, 90% losses from the listing price. Now, at a certain price, if you think certain business models have become interesting, just because the how we look at these stocks would be that have the market shares consolidated? Are there limited number of players now? Do you see long-term tailwinds in the sector? Do you see growth prospects? Do you see the burn ratio could be coming down because the startup funding is also drying now and people are becoming no profit conscious. So one of the players, the insurance aggregator, was available at a market cap adjusted value of around 15,000 crores a few months back, adjusted for 5,000 crores in the balance sheet. Now, at that price, you were getting almost two unicorns, Paisabazaar and the Policybazaar, the insurance arm and the credit lending arm. And, you know, the management has been doing a good job. They have 90% market share in the online space. And overall space, they have 1% market share, which will keep growing. So this is how you start building a narrative, then start going deep down in these ideas and look at them at the valuation which you want. Now, this narrative was there 1 year back also when these stocks were at 4x, 5x the valuation. But a certain valuation you can look at these. That is what market presents. In euphoric terms, the same business a year back was 3 to 4x expensive. And in pessimism, the same business is 70, 80% down available. As an investor, we need to see at what point do we want to place our bet. Otherwise, let's keep studying. Similarly, I think the pharma and IT sector, nobody seems to be looking at them. Some of the companies in the mid-cap space are delivering good results and are getting interesting valuations. So that is how you need to keep looking. Now, it doesn't mean that capital goods, autos, defense, one should not touch just because they're in momentum. Sometimes in these momentum sectors also, one may find companies which may be interesting, cheap, or market may not be, but becomes difficult. It becomes difficult because everything is going up and the sector is in momentum. So it is always easier for a long-term value investor to look at sectors which are ignored, but here we're not looking only for deep value. Please understand. A lot of businesses would remain deep value for a long term. So growth is the biggest catalyst which one should look for. Just deep value will not be an easy way to make money. If deep value is accompanied with growth, your valuations will improve faster. Your valuations will become better faster. So always look at sectors or companies or management which are executing well and growing well. So that is also one way we look at. And one more thing which we can look at is certain businesses which you were eyeing but were very expensive, but due to this market correction have fallen a lot and have become quite interesting. They may not, so very high quality businesses may not become absolutely cheap. For example, a CRISIL may hardly have come to a PE of 15, 20. So that may be difficult that in very high quality businesses, you will be able to find them at very cheap valuations. But otherwise, if you see a very good, decent correction, wherein the stock has fallen, say 50, 70%, and the business is still growing, business still looks robust, just because the sector, market is not looking at that sector. So in the financial space, scripts like Aavas Home Finance, which are very good long-term quality compounders in the space in which they're leaders in affordable housing finance and developed a moat and everything. Those businesses appear to be coming at valuations which could become interesting in the long run. Again, a thought to look at. So as a theme, you're looking at either the sectors where marketers are ignoring or sectors where the punishment has been more than the market requirement, or some new tailwinds are coming, like the edtech sector I mentioned, or market got disappointed with a few IPO performances and or sub companies' performances and painted everybody with the same brush, and everybody fell in the same segment. What happened with the tech IPOs? Some of them have consolidated market share. For example, if you look at another company called the fashion retailer, Nykaa, there it may be difficult to take a long-term call. Why? Because the consolidation has not happened yet. There are still a lot of players like Myntra, Amazon Fashion, and other players trying to come into the space. So where consolidation has not happened, where market share fight is still going on, where bloodbath is still on, it may be difficult. But that is not true with the other case I just mentioned in terms of the insurance aggregator. So that is how one needs to look at these various investing styles to look at the other players, how you can make money out of that. At the same time, always look at how growth has to be a component, how balance sheets have to be either deleveraged or reasonably leveraged so that they don't suffer in this madness which is out there. So that is what I would say in terms of how we look at sectoral investing themes and how to benefit from them when markets present these opportunities. And obviously, any long-term compounders in any of these sectors are always welcome. But if it is not a compounder, even if it's a 2 to 5 year bet, that could also be interesting along with your core compounding portfolio, and you can benefit in this. Another script which we have been tracking for a very long time, for the last 10-15 years in the IT space or the tech platform space, is one of the companies called InfoEdge. Again, excellent management, excellent track record, excellent execution. Now, if you think that long-term hiring story, every time we hear a disruption, be it ChatGPT or be it recession, people reskill, upskill, and they keep growing. So if you believe in that long-term story that hiring is here to stay, and this company will be a leader, a part of that, so then these kind of businesses become attractive at a certain valuation again. And plus, you have excellent governance and optionality of the startup investing, which is happening. So that is another way where if you're getting that optionality at a reasonable valuation or at zero growth, at a free cost, then it becomes even more interesting that you're not paying up for those optionalities coming out to be true. So that is another way to look at. And certain times, if you look at, for example, the dairy sector now, because of milk inflation, a lot of these companies are continuously growing their top lines, but are not being able to improve their margins. So sometimes opportunities could come because of cyclicality in margins, which are not normalized. And as soon as the margins normalize again, because of the huge top line, the operating leverage will be huge and the delta in profits could be huge. So again, that is also one way to look at certain companies in certain sectors as an investment framework to look at opportunities. So that is how I would say we also look at special situations in terms of change of management, wherein certain new managements are coming. Example, Adore Welding, the professional management was removed and the family management came back into the company. Or if you look at how demergers are playing out, wherein, for example, a shoe company demerged its business and how market unlocked its value. Or in a company called Styrenix, which was earlier Ineos Tyros, how erstwhile CEO has come back and now trying to say that I will scale up this business, bring up valued products. Now, this may not be an immediately idea which you jump on buying, but certainly something interesting to track, because a great management can really execute well in the country like India. More than the moats, a great management can create a lot of value. So if you keep your eye open for such kind of opportunities also, historically Crompton Greaves Consumer, when Advent came as a management, delivered great value. So similarly, if you think the same playbook can play out in Eureka Forbes, now one may look at valuations, that valuations may not be interesting as such, but keep tracking such stories. And certain times when market gets pessimistic over a few quarters, one may look at that and that story could still be interesting because the management is investing for the long run. So that is also one way to look at such stories. Or where the management is in themselves making a voluntary open offer, like what happened with Camlin Fine or other companies. So that is also one tool, special situations. I think one of our friends, Neil Behel, also keeps talking about them. And severally, there are a lot of other players talking about it. There's a book by Joel Greenblatt also on how to be a market genius. So this is also one tool which we use to look at opportunities among sectoral investing themes which are there. Shyam sir, over to you.
Shyam, can you take over?
Yeah. Ashish, you are mentioning about a lot of these contrarian themes for the coming year. Do you think that these are all themes that are meant to be owned for 1 year, or how long you think these themes that you mentioned will need to be owned? Because some of these are companies that are just listed in 1 year, 2 years vintage in the stock market. So what do you when you look at contrarian themes which are sectoral, what is the kind of gestation you're looking at? How long do you think people should own those?
Okay. So that's a superb question, sir. So I think sir is bringing a very important point that when you have companies which have been listed for a very long time, so the share market history or the stock market history itself is a good indicator in terms of the wealth creation done by the company in the past and the track record and the execution and the capital allocation and how they rewarded the shareholders. That is something which is missing when there are new companies which are being listed, and especially in companies which have been new IPOs, where we have to sometimes go with the unlisted track record or take a bet on those managements. So to answer to your question, sir, as personally, whenever we are looking at investing, we are taking, say, a period of few years to come, 2 to 5 years. Definitely, it's not that the company will not perform after 5 years. The window may be long, but the next few years, if the company is growing well, if the sector is poised to grow well, and if the management executes well, you keep holding on to the business. You keep looking at how the numbers are improving, how the execution is panning out. sometimes what happens is companies make a big capex, but they're not able to execute well, and it becomes a reverse operating leverage also, something which has played out in company like a Dynamic Products or other companies. So one needs to be very careful that the company has some pricing power, the growth prospects with the company is saying company is able to benefit from the margins, and then you keep tracking the execution. If the company doesn't execute well or does a missed capital allocation or does something wrong, then you exit. Otherwise, before investing in the company also, you should have a visibility of, say, long term, but then you keep reevaluating as the company performs.
If you look at most of the people who are looking at contrarian themes today, they are looking at the themes which have not done well in this year, but we did well 2 years ago. The recency bias seems to be cropping in. Even we are seeing so many people ask about APIs, pharma, chemicals. You mentioned one name just now. So they are not doing well now. They were on top of the world just, let's say, 12, 24 months back.
Correct.
So how do you know that these companies have actually come into the zone of investment comfort? Because merely because they have fallen and they're out of favor and they were the darlings of the market 2 years ago, one cannot really take a contra view. So how will you do that? Because many of these companies may actually take much longer cycles, because that is their history. If you look at many of these companies, you mentioned one, they have done a capex. You see that when a company does a capex, how long will you wait? I mean, how long are you willing to wait with the contrarian thing? Because the capex has to again come back to reasonable utilization, and the market should be as favorable in the emerging scenario as it was in the past, because there's a very high chance of that diverging, right? So how do you manage those things?
Again, a great question, sir. Sir, I would say that as investors, we do tend to see the fall from the top. And a lot of people, including us also, sometimes do get influenced when we see that the stock has fallen, say, 40, 50%, 60%. It was a darling of the investors a few years back only. And one may seem that, but one needs to reevaluate. What we also do is, from a fresh perspective, that if we had to invest today in this company, irrespective of the price fall, are we sure, first of all, what led to this price fall? For example, personally, I sometimes do not understand a lot of these pricing mechanisms or the pricing power of a lot of these companies in APIs or something. So if I don't understand that how the margins will move in this company, and if I only rely on the management commentary, then obviously I'll be taken for a surprise. So as an investor, it is our job also not to just rely on the management commentary, but also have our own study, our own perspective on how these cycles have played before, and see how the industry is shaping up. Because management normally is eternally optimist. And typically, sometimes even with the best of intentions, they also go wrong. Because as a business owner myself, I'm always optimist and I'm trying to run my business and motivate my troops. And so to take an example, as I mentioned about the banking financial sector, now where if I see that the businesses has deleverage, there is a growth potential out there, secured lending, wherein the disruption of fintech is less, and there's still a lot of paperwork out there, and there's still a lot of opportunity out there, where I can see a potential out there in terms of, as an investor, that this business will grow. Not just relying on the management commentary, but I can visualize myself certain businesses. Those businesses are ones which one can take a contrarian bet and average, because you are betting then on the earnings growth potential rather than the PE expansion or deceleration. And the earning growth expansion will take care of the PE deceleration, if any, from your price. But if you're not even sure of the EPS earnings growth or the margin, how will they play out, then you could be taken aback for a double ride, because the markets may be correct in punishing those companies. For example, in COVID times, a lot of these diagnostic companies had got one-time earnings, and market gave them very high PE multiples. And so it was a Lollapalooza effect that on a short-term earning, you got a very... Now, even if the stock has fallen 50-60% from the top, still those market earnings and multiples need to be rationalized for one to take a bet on that. So it is definitely something which is challenging for a normal investor to take a contrarian bet. I would suggest a retail investor to stick with the bigger good names, blue chip names, which have performed well, and they've been consistent record over long run. At the same time, they are available at decent valuation. So, for example, one of the stocks, the FMCG stocks called ITC, a few years back, when everybody was criticizing everything, we had even presented in one of the forums, was available quite dirt cheap. And so sometimes you need to look at, is it become the darling of the markets? Is everybody seeing only positive out there? That means the stock is getting priced to perfection. So maybe there's no one right answer to that, but one's understanding of the sector is paramount to take any contrarian bet. And if he or she doesn't understand the pharma sector, they should stay away from it and maybe limit themselves to the circle of competence they have.
Ashish, one last question before you open the floor for others. You mentioned that you give time and you're willing to wait if you're getting evidence and all that. That is after you purchased the stock and waiting for the result. How much time do you give yourself before you purchase? I mean, what is the kind of lead time you give to do your research in a contrarian theme? When do you actually get that confidence to buy? Or you buy and then do your research? How do you do this?
So, sir, once again, there are certain styles. Sometimes, for example, the valuation may be too interesting. So, for example, the company may be trading very cheap X of cash and the normalized growth. And one may say that I'm not paying up for growth at all. There, one may take a little stake immediately also, because valuations are very close to the COVID levels. Or so sometimes they may look at as anchor prices, but they do give a sense of comfort if fundamentals also look nice. The valuations are close to some anchor levels. Otherwise, most of the times you do your work, and when you give enough time in the markets, so last cycle, if you studied a business, you've seen it, how it plays. So then you have a fair bit of understanding. For example, I've been tracking the banking financial sector for a very long time. I run an NBFC company of my own also. So here I know how cycles are playing out and how they're doing well. And I see the industry practices also. And so there it is easier for me to understand that now the pain seems to have bottomed, the growth is coming. And a lot of times these businesses, I always believe that if the runway is long, even if you miss the initial one or two stops, it is okay. Because if you get the stock correct, that is more important than trying to jump on initially and then keep selling out later, because it affects your confidence also. A lot of it is your mental confidence also, and not just the potential loss you may have by doing this activity. So I would always believe that one should do their work and then try to play on this. And if sometimes you miss on certain opportunity, that's okay. That work will not go waste. It will help you evaluate other businesses, other opportunities, or another cycle. It will give you the same chance to play again. But however, sometimes, for example, in the case of the insurance aggregator out there, at a certain valuation, we were thinking that market is pricing it, that it will almost fail. If you think that this business is coming almost for a very low growth potential or being priced for failure, then one may take that call also based on the judgment and the experience, and then add more as per the study as they keep going on.
Let's now open the floor for some questions. I would request those who want to speak to indicate so that one by one we can give an opportunity to speak. Anyone ask a question to Ashish?
Sir, we've got 2 requests already. Can I approve them, sir?
Yeah, make one at a time, please.
Yeah, okay. Mr. Devesh is now a speaker.
Yeah. Good evening, Shyam sir, Vignesh sir, and Ashish sir. Sir, my question to you is, you were discussing about contrarian bets. I want to get a outlook whether do you have the same view, like is shipping a contrarian sector as of now, and there are some listed tanker stocks, a stock which is having a good tanker fleet, and worldwide the cycle has consolidated. The shipping cycle have never turned back from 2008 levels, and now things are changing. Do you think this is a good investable sector going forward?
Thank you, Devesh. Firstly, let's just like to clarify that while it may appear as a contrarian, see, our job is not only to be contrarian for the purpose of being contrarian. We need to keep evaluating risk reward opportunities of framework, that what is the risk we're taking, what is the reward potential. And sometimes it is difficult to find them when the stock is in too much momentum. But you may find certain opportunities in that sectors also which currently are in momentum. So one need not be contrarian just for the sake of contrarian. Coming to your stock specific or the query on the shipping sector, see, what we also tend to do is, with our discussions with a lot of industry professionals and peers and friends, we also keep asking and we also keep trying to follow up on which are the best players in the industry if you have to play that industry. For example, Jesco is one of the best players in the shipping industry. If you talk to anybody, their capital discipline and all of these things are top notch. So that also helps. And then you try to keep studying these companies, these cycles. You keep looking at financials, how these companies are doing well or not doing well. I myself am not an expert on the shipping sector as such, but as I told you, this is how I would look at that. I will try to talk to people who understand the sector very well and try to look at past financials to look at how margin cycles have played over the last 5-10 years. Try to look at indicators like a Baltic Dry Index or the shipping freight rates or other things which affect the utilization. Look at the management commentary. Have they invested in bad times? Have they bought cheap assets? Have they benefit from the downturn? And are they primed for the upturn? So, for example, if you look at, say, suppose a real estate company, sometimes in the bad cycle, when you have an opportunity to buy assets, if you are perennially conservative, you miss that opportunity. So one is just surviving the bad turn or the bad cycle, and a great management benefits from the bad cycle. So those things need to be seen. And then how leverage is the balance sheet and how they play. And then on the basis of these factors and indicators, one can look at that. I think cyclicals also, a lot of their smart investors like Jitin Parmar Bhai of Aurum Capital and other people, even Shyam Shekhar sir also keeps mentioning about how to be careful in certain businesses and companies. So I would say this requires a lot of homework, and not just because the stock has fallen a lot, we need to be. So be careful. Unless you have a detailed understanding of the sector, don't jump in. Requires a lot of homework.
Thank you, sir. Thanks for the input and your views. That was very helpful.
Yeah, Mr. Ilavarasan is now made a speaker. You can ask your question, sir. Hello, Mr. Ilavarasan? Okay.
Yeah. Hello. Shall I proceed now?
Yes, sir, you're audible. Please go on.
Yeah. So thanks, Shyam sir and Miss for hosting this session. So now I'll ask my question to Ashish. So Ashish, I had a question. So right now, the tech space is down, right? So everyone is looking for a service sector. But there is a niche play like LTTS and Tata Elxsi and KPIT Tech. So these are mostly spoken names, but they are down so much. So will the value migration on ER&D space will really happen? So this will be a contrarian play or not? So this is my question.
So again, I would say, my recommendation would be that stop getting into this contrarian or not contrarian. Look at risk reward. So Tata Elxsi for sure has corrected, or these companies may have corrected. For sure, these companies will keep growing. But look at, even after this correction, at what valuations are these trading. You can use reverse DCF models of Tijori or even Screener, where you can use reverse DCF to see how much growth has been priced into these stocks. And there was a recent talk by Professor Bakshi also, where he mentioned that how Graham used to, rather than estimate the fair valuation of the business, used to just see in terms of protection as what level of earnings or what level of comfort is there in the valuation, that the business should be at least this much, or the business should be at least valued this much. In these companies which are already well discovered, like Tata Elxsi or LTTS, and which have taken a correction, one needs to be sure that the growth momentum needs to be intact. If the company, as per your analysis, will grow in high double digits and with good margins, and the earning growth could be, say, upwards of 20-25% for a long time to come, then from these levels also mathematically you will make good amount of money. But otherwise, if you remember 2001 bubble, it's not that Infosys and all these companies stopped growing, but their valuation had become so steep that even when the businesses were growing, they kept getting derated and almost went sideways for a period of 5-10 years. Now, the same thing could happen here also. So one needs to be sure while paying up is not a bad thing, but one needs to be very sure that the growth then comes, because any surprises on the growth or the margins will take away your potential profits, because market will not give any room for miscalculation on that part. So that is, as an investor, you need to see, do you want to pay up for growth? Are you sure that the growth will come? Or you want growth at a reasonable valuation or growth for free? And that, depending on that investing style, you look for such companies. In case of Tata Elxsi and LTTS, you definitely need to be sure that the companies are still richly valued, that the growth will come.
Mr. Jitin Farmer, you can go ahead.
Yeah, thanks. I just joined a few minutes back, and I wanted to add to this specific question. So we also have to see, I mean, if you look at P of these companies, something correcting from 100 or 90p to 60 or 70p does not make it, cheap. So we have to understand what valuations we are paying for. And as Ashish rightly pointed out, if we have a confidence of, 25% CAGR for many years in earnings growth, then maybe we can look at, paying up something like a 50p or something. But if we are not confident of that, then I think, we might not get the desired results, is what I think.
Thank you, Mr. Jitin. Thank you.
Thank you, Jitin bhai.
Vignesh, you can allow the next person.
Yes, sir. I've made Mr. Majid the speaker. Now you can ask your question, sir.
So, good evening, Ashish sir, and good evening, Jitin sir. Thanks for giving us opportunity, and good evening, Shyam sir. So, I think there is one question for me, sir. Actually, nowadays, I just wanted to understand one thing, that nowadays finding good stocks and good businesses and opportunities are very easy, but the real problem what I am facing is when to book those profits, because recently something happened with me. I have just invested in one stock, and that stock has gone more than 150%, and I have not even booked anything. And unfortunately, the same stock has come back to the same my entry level. So, is the market dynamics has been changed, sir, because of the flow of information, or the how to in this new, is there any changes as compared to the previous market environments? Because nowadays, if any news comes, then you can see the market will be just falling like sharp 5%, 10%, and these things. Then everything will be just all the profits will just go in those things. So that's my question, sir. Thank you.
Thank you so much for your question. So see, there's no right answer for this. How we are handling this, and again, I would like to say humbly that there are various investing approaches. No one approach is correct. So one needs to follow what suits them. So as a fundamental investor, one can follow, for example, Achak Akre or other celebrated investors when they mention that you keep holding the business till it keeps performing, till it keeps management keeps doing good job, they keep executing, they don't deviate from their plans, they don't do a misallocation, they don't do any corporate governance issue, the business model is not broken, till the time structurally the business moat or quality is intact, the market share is good. So look at those factors, keep holding on. Certain investors like Achak Akre will say, then if you have these conditions, then keep holding on forever, don't sell. A lot of the gurus will say that if the valuation becomes too expensive and it gets priced to perfection, you may book profits. What we also do, as in, I'm not saying advising all of you, but certain businesses we don't really understand very well. And a lot of times we're relying on management commentary, or our understanding of the sector is not as good. So we also look at long-term technical charts or monthly charts and everything to get a feedback. If those monthly charts are correcting a lot, irrespective of the market fall, we also then take that into account. But for a normal retail investor, I would say the first approach, as in if the business is performing well and the management is excellent quality, see the journey of any multi-bag or any long-term compounder, you will keep having corrections in between. And if you hold on to a long-term compounding story which can compound, so look at Titan and Asian Paints and everything, you get those things, you keep compounding, you will make good amount of money. The second thing is most of the companies are not Titan and most of the companies are not Asian Paints. So most of them need to be booked at a certain price when they get expensive. So that is the difficult, that we can't apply the same playbook of long-term investing. The stock will tell you that whether the stock deserves to be held or the business deserves to be held for long run. You can't apply your investing framework that because I'm a long-term investor, I will hold a commodity stock also for long run. No, the stock business will tell you. And so if you look at the past investing cycles for that business, you will know that's a commodity stock. If you look at how the valuation the stock has traded, it will give you an idea. Very few rare businesses would fall in the category of Asian Paints and Titan to be held for time immemorial. Most of the businesses would fall in the category that sell when very expensive and buy. And technicals, as I told, if your understanding of the sector or the business or the company or those things are poor, it may be used as an aid to get some feedback from the market and could be used. It may not be used. It is upon your choice. So that is how we would look at this query of selling about stocks. Also, in terms of last point would be allocation. If the allocation has become too huge for your portfolio, and if your confidence level is not too high and you're getting sleepless nights, it's better to cut it down to a level where you feel comfortable.
Yeah. Thank you, sir. We have time for one last question from the audience. Mr. Ravindra, you can ask your question, sir.
Hi. Thank you, everyone. Good evening, everyone. And it's a very, very too many insights to capture here. I have a couple of questions. The first one is, as you mentioned about the insurance aggregator, all right? So what's your view on insurance sector overall with, surprises coming in name of budget provisions and tax provisions and other, mis-selling and other allegations which come up every now and then. I'm talking specifically about life insurance sector. And the second one was about the habit change in terms of psychology of people. I'm talking about the delivery businesses, which is listed. I'm trying to bring in a recent experience which was which happened in one of the key unlisted partner, wherein some business-driven decision caused furore in terms of the revenue. I'm specifically talking about Blinkit. What happened in Gurgaon. So how do you see that as a sector for mid-term to long-term investing? Because one thing they have is the data of user, and also they are driving the psychological change of next decade. That's all. Thank you, sir, for giving this opportunity.
Again, good set of questions. I think the first, as about the insurance part which you mentioned, see, any businesses which are regulatory driven or purely dependent on regulatory arbitrage or any regulatory benefits, those benefits which are there could go away anytime. It has happened many times before also. So our investment thesis as a fundamental value investor should be mindful of the fact that this is something which has been there but could go away. Our thesis or our understanding of the sector of life insurance or anything is, in fact, post-COVID, you will see more awareness of the need for life insurance or health insurance. And we believe in the long run that these sectors should do well. Now, doesn't mean a sector, for example, telecom sector has done well over the last 10-15 years. But because industry dynamics were not favorable, the competition was too intense. So, see, these are all starting points. One then needs to do their own spade work to see that you go with the narrative and will it translate to the bottom line of the company. Otherwise, what happened in telecom sector that users grow, the business industry grew, but nobody made any money in the telecom sector for a very long amount of time. So, as I mentioned, the ranking of business models also, or any framework which you have, evaluate whether the opportunity size will translate to the bottom line of the companies. Our view is positive, again, with all disclaimers of SEBI and that we're not registered. On the second question of the delivery business, which you mentioned, habit change is a very powerful technique. And I sincerely believe, with all due respect and humbleness, that sometimes even when the incentives are taken away and the discounts are taken away, the convenience which something offers, when the need which is there, and the habit change which happens. But do the business economics make sense? If the business economics only don't make sense, then it may not be. A Concorde, a plane which was taking a person from, say, London to US, which was cutting down time travel by 80-90%. Now, if the business economy doesn't make sense, even if there's a need for it, that product will not do well. So one needs to see that certain times the scientific experiment or invention or some business model is not commercially viable only, or not scalable or not feasible, irrespective of the competition. Then one needs to be careful of that. If the business model is viable, if the business model, then as soon as the players fight with each other and winners emerge, and there's a consolidation in the market share, then one can look at opportunities and always keep in mind that what valuation are you paying for them. When businesses are not earning profits, you need to be very sure that you are being mindful, and you may need to look at hacks like how much money they have utilized. Now, a lot of people will say they have burned this much money, so at least they should be worth this much. No, that is not a criteria. These are all anchor points. Always and always, what are the future potential cash flows out of their business? And these are approximations one may use to look at those businesses. So I will touch businesses which are not making profits only when I think the business model is viable, the market shares have consolidated, there is a clear winner out there, and they can raise pricing power gradually with time. There's no issue, and they can make a lot of profits in the next coming years. Only then I would touch them. Regarding the last question about Blinkit and how, so if you think the management governance is not up to standard, or the decisions are not being played out as per your comfort, and it is a material decision, one may need not participate in that growth story. There are many stories available in the market, and they will come in the future. One need not participate in all of them, even if they deliver multi-bagger returns. The process needs to keep getting refined. And what we need to always make sure is that while we give some leeway to the management, it's like Professor Bakshi always says that before marriage, keep your eyes open, and after marriage, keep them half shut. But that doesn't mean you let go of all corporate governance lapses. If you think it is a material lapse, you should not play the story or exit the story. That is how I would say. A lot of times, people also technically play such stories, saying that, for example, in one of the companies like the food delivery business, the recent low, taking as a stop loss, they play such stories. So as I told, there are many ways to play an investing story from a trader perspective, from an investor perspective, technical perspective. You need to choose your investing style, but be sure that you follow the process and the discipline associated with that style. And that is when you will get returns.
Great. Now I'd like to call upon Mr. Vivek Karwa.
Vignesh,
Yes, sir. Shyam, sir?
Shyam, you want to say something?
Something?
no, I said we can have one or two more questions. We are already at 10 to
Okay. Yeah, okay.
maybe one or two questions, and then we can have
Sure,
our
sure,
closing
sure.
comments.
May I request people to raise your hands if anybody has a question?
Any other questions for Ashish?
I think no more questions. Yeah, Vignesh, shall we proceed then?
Vignesh?
Yes, sir. No, there is a couple of comments that has come in the spaces actually. I can read that comments
I
out.
think he has some connectivity issues.
Dwarak is requested.
Yeah. I'll accept it. Yeah.
How to allow him?
Yes,
Vignesh has to allow.
Mr. Dwarak has been now made a speaker. You can ask a question, sir, now.
Yeah, Dharak, you can speak.
And also, Vignesh, there were some questions in the Twitter handle.
Dharak, you can speak. Unmute yourself, please.
Hi guys. So thanks Shyam and everybody. So I'm a silent listener though, so it's a nice topic. I'll come straight to the question here. So this is regarding the FMCG sector. See, we see the volume growth going up like hell during the COVID times, and then people were buying and things like that. And once the inflation came up, it bumped on to these cost of the consumption. I mean, the input cost went up, and now the FMCG sector is the ones. Like always evergreen sector is still not able to cope up with that. How do you see this? I'm a long-term investor. I'm asking this as a generalized query for the larger scale-up audience. How do you see this as an opportunity where you can find some great companies which are available, or still there is much more discounts that has to come down to re-enter this sector? Thanks.
Thank you, Dwarak. I think one needs to be very careful in this sector. A lot of the bargaining power is shifting from these FMCG players to retailers out there, the brick and mortar ones, who are also coming out with private labels. What is playing out in the West could play out in the long run here also, wherein the companies like Costco and are the ones dictating the prices, and their private labels are the ones the customers are vying for, because they are the end touch point with the customer. And given their muscle, given their distribution strength, given their volumes, they are squeezing the FMCG players, and they end up becoming contract manufacturers for those retailers. Now, that has not happened as such almost, but certain signs are visible in a lot of sectors. So unless the FMCG player is having certain things which create a customer pull for that product, otherwise the private label will come and replace it. That is what is happening and will keep happening. And what are the valuations you're paying? Gone are the days where an FMCG could continue easily to grow in double digits and keep increasing its margins. Nowadays, this cutthroat competition. So you look at biscuits, you look at any category, and there are so many brands out there competing for the same shelf space. Look at chips. Companies like Pratap Snacks and other companies from the IPO times have not performed. And it is very difficult to perform when, as I mentioned the example of telecom space also, when you have a similar product which is not very well differentiated, you have a cutthroat competition, it's very difficult to generate bottom line. So I would be very watchful of the FMCG sector in terms of the bargaining power it enjoys. I would in fact look at contract manufacturers in the food industry, wherein they don't need to struggle with who is the winner in the industry and who would want to supply to the leading contract manufacturers, or look at the people having the bargaining power like retailers who are doing the models which are successful in West need not be similarly applicable in here, but I could take a leaf from there and study those models. But I think the FMCG players could get squeezed as these retailers keep doing that. So keep that in mind. And the valuations, I still don't find them attractive for the most of the FMCG companies. And the food inflation and the thing is all again a reflection of the pricing power which they have, that it is difficult to pass on food inflation beyond a certain level. And most of the products are non-differentiated. So customer will always keep shopping amongst these choices out there. So that would be my take on the FMCG sector. In terms of evergreen, evergreen means that the demand is always there for it. But that doesn't mean that the sector will create a lot of profit potential for the investor.
See, for example, some companies are trying to buy other companies. For example, Dabur recently entered into a space which is not in the spices. ITC entered into spices. I think there is a kind of a consolidation that is happening. So doesn't that sound more interesting, where you consolidate and try to enter the spaces where you are not been?
So correct. And again, thanks for pointing out. Again, showing that it is difficult to keep growing, and consolidation is bound to happen. But as I mentioned earlier also, that when the valuations also give you an opportunity where you're not paying through the nose for execution or for such high growth, FMCG typically is in low double-digit margins, how they have grown. And volume terms, for most of them, could be even less. With value accretion, with value and price, they were doing 10-12% in terms of revenue growth. So I give the example of how ITC was available at a throwaway valuation, wherein you were not ascribing any valuation to the FMCG part of the business. So that could be that was an opportunity. So maybe a few years, sometime back, a company called Vector Foods, again not an investment recommendation, but was only being looked at the biscuit company, but the contract manufacturing arm was doing quite well, and the scalability was quite well, as I mentioned, in terms of contract manufacturing out there. So you need to look at something which is either attractively valued, or you're very sure that the growth, companies like Dabur and all, at the size which they are, I would be surprised if they can continue to grow at 20-25% earning growth. And if they don't continue to grow at 20-25% earning growth, even in the history, if you see the last 10-15 years, sales growth have been, say, below 10%, and profit growth has been around 10-12%. So at these multiples also, it would be difficult to generate a good amount of return. So that would be a humble submission. But as I said, if one is confident of a good growth potential out there because of these M&As and everything, then one can certainly look at it. I am a little skeptical at the size of the companies and the past track record and the potential of disruption from these retailers, and would want a very juicy valuation to play these companies. Otherwise, would stay away. That's my personal opinion.
Thank you.
Tash, I know
Yes,
we
sir.
have a lot of time. Shyam, two questions on the Twitter handle. Sir,
Yeah.
if chemical companies will be under continuous margin pressure due to growth in China's productivity, kindly enlighten. And the second question is, how to get the timing right in sectoral stock picking? There was one more question about IT sector. I think you have answered that. One is about timing in sectoral stock picking, another about chemical industry. Please go ahead.
See, firstly, let me talk about the timing part of the sectoral stock winning. See, if you talk about the value investing theme or the fundamental investing, long-term investing theme, typically you're not trying to time the stock. What you're trying to see is buy a stock at a good valuation, and they execute. As they perform well, you keep adding on to it. The challenge is a lot of us look at only deep valuation and not growth as a trigger. So the opportunity cost could become very huge. But if the company is executing well, if the company is growing well, if the results are coming, the profits are coming, if they're growing very well, if the company has good governance, if the company has a longevity of growth, then market in the long run is a weighing machine. It's not a voting machine. So those things will reflect. And you will see sometimes even in bad markets also, companies which are performing well on all these parameters, value is discovered out there. So I would say timing is more a question in terms of companies which are deep value, and you need a catalyst for such companies. And their technicals or some catalyst in terms of policy changes could be one way to play those companies, because you need a catalyst to drive value. Otherwise, companies which are growing very well and have good governance and other track records, growth is itself a catalyst, and markets will have to sit up and take notice and cannot ignore if the company is growing well at available at a cheap valuation, provided all the other metrics which I mentioned. See, investing is not like one variable only. When I'm saying a certain thing, I'm assuming other things are also very good balance sheet, good growth, good management, good prospects. Considering other good things, market will take notice of it and drive valuation. Now, in terms of the chemical companies out there, see, all these companies, so when the tide is favorable, like China Plus One and everything, there is a time of phase where everybody benefits from the increase in the prices of the chemical companies. But it's only when the tide goes out, or when there is a pressure in the tide, or when there is a realization that supply will come back, then when you realize that most of the companies don't have pricing power, either they're not backward integrated, or they are not scalable players so that they can command the lowest cost, they have the lowest cost, or the use was temporary. So as I said, chemical also, like any other commodity company, one needs to focus on the supply side a lot to play such companies. And very few companies would have pricing power. And that pricing power would also emerge because either the industry is too tough to enter or to get approvals, or a product is too difficult to handle. For example, a fluorochemical would be a too difficult product to handle. Not the chemistry would not be easy for everybody to do it. So there needs to be some specialized chemistry. The supply needs to be favorable. Only then one can command pricing power in the long run. Otherwise, like any other commodity, the chemical company margins will also swing from one end to another, and investors looking at historical valuations will be taken away for a toss and will lose up a lot of money. So please don't extrapolate past earnings. Be mindful of the fact that, as Howard Marks says, most companies are cyclical. I would say almost all companies are cyclical. Some of them have short cycles, some of them have long cycles. Even FMCG companies, I would say, are cyclical. And we are witnessing that right now also.
Thank you.
Thank you, Ashish. I think you answered that very well. We already short our time by a few minutes. I'd like to thank all of you for participating in this spaces. It was a very, very interesting session on a very engaging topic. And it was nice to have many friends here like Jiten and very many others whom I may have not named. It's good to see all of you on this spaces. I'm sure that the conversations will continue and be meaningful in the coming days. Thank you, Nagapan, for hosting this on behalf of HCC, and it's a wonderful evening. Thank you very much.
Thank you, Shyam. Thank you,
Thank you. Thank you so much, everyone. And thank you so much, Shyam, sir. It was a real honor to be on the same space. Thank you so much.
Thank you.
Thank you, Vignesh.
Thank you, sir.